I can't believe I'm doing this. I'm talking to you about the coming housing bust that is very much closer than the horizon at this point. I thought we were done with that nonsense after 2008, but no, we're right back where we started. I really wonder if I am insane or else the only sane person in a world of absolute basket cases. This cannot be happening. Some of the same characters that played leading roles last time are back in the saddle. The value of the US housing market has ballooned to $26 trillion. In many markets, prices exceed even the peak of the prior housing bubble that blew up so spectacularly. This construct is weighed down by $14 trillion in mortgage debt, or about 76% of US GDP. Of that, $10 trillion is owed on 1 to 4 family residences. The numbers are big, and they matter. But you must be wondering, who's doing the lending? And the answer is that more and more it's non-banks, evocatively called shadow banks. They have now overtaken commercial banks to grab a record slice of government-guaranteed mortgages. Atom Data Solutions reported in its housing report, these shadow banks are different. They typically borrow from Wall Street hedge funds, private investors or banks to make loans, then quickly sell these mortgages to Fannie Mae and Freddie Mac and other buyers so they can repay their loans and start the process all over again, just like before. Non-bank lenders dominate the origination of mortgages insured by the Federal Housing Administration, FHA, and by the Veterans Administration, VA. The riskier corner of housing lending due to no down payment or low down payment loans and poor credit buyers. So you're right back to subprime mortgages with low or no down payments. These government entities don't actually make loans. They buy loans from lenders, package them into mortgage-backed securities, and guarantee them to make investors whole if the mortgages default. Wells Fargo is still the largest mortgage lender by far, with 26,262 purchase mortgage originations in the second quarter, according to Atom. But number 2 is non-bank Quicken Loans, with 18,753 originations, followed by Caliber Home Loans with 13,580 originations, followed by Bank of America, Fairway Independent Mortgage, JP Morgan Chase, Movement Mortgage, Prime Lending, Guaranteed Rate, and Gilt Mortgage. Of these top 10 originators, shadow banks originated 63% of the mortgages. These shadow banks are barreling into the market by going after riskier borrowers and government-guaranteed no down payment or low down payment mortgages with impeccable timing, now that the Fed's monetary gyrations have inflated home prices nationally past the prior bubble peak and in many markets far beyond the prior bubble peak. And some of the same characters that played leading roles in the last housing boom and bust have reappeared. Remember Countrywide? In California, some of the largest non-bank lenders include PennyMac, AmeriHome Mortgage, and Stearns. All three are headquartered in Southern California, the epicenter of last decade's subprime mortgage lending industry. And all three companies are run by executives who formerly worked at the once giant Countrywide Financial, the now defunct subprime lender founded by sun-drenched Angelo Mozillo. Bank of America bought Countrywide for $4 billion in July 2008. PennyMac, a fast-growing non-bank lender, is run by Stanford Kurland, a former Countrywide Home Loans executive and IndyMac director. Stearns, a Santa Ana, California-based non-bank lender, is run by Brian Hale, a former Countrywide division president. And Joshua Adler, who is a Mary Holmes managing director of secondary marketing, held similar roles at Countrywide and Bank of America. Banks still originate the majority of mortgages overall, but barely. Their share has dropped from 91% of originations in 2009, after many of the shadow banks had collapsed in the housing bust, to 51.7% so far in 2016. The share of shadow banks has soared to 48.3%. These shadow banks dominate in mortgages that are insured by the FHA and the VA, including no down payment and low down payment mortgages for buyers with subprime credit ratings, the riskiest mortgages out there. Thus, FHA and VA-backed loans have jumped from 6% of all purchase originations in 2006 to 30% in the third quarter of 2016. According to Guy Sekala, publisher and CEO of Inside Mortgage Finance, he told Atom, and I quote, "The big banks have restricted their mortgage business. Instead, banks like Chase and Bank of America are making jumbo loans to more affluent borrowers. More than 50% of their business is jumbo loans." End of quote. Jumbo loans are not insured by the government. Non-banks and the government are picking up the rest. Increasingly, the federal government, FHA, VA, Fannie Mae, Freddie Mac and Ginnie Mae, has played a larger role in the mortgage financing industry as the large depository banks retreat from the home loan market. In all, these 5 entities own or have guaranteed more than $5 trillion in mortgage risk. That's about half of the outstanding mortgage risk. The role of the government entities that insure high-risk subprime mortgages has soared. The FHA insured 3.4% of all mortgage originations in the first quarter of 2006. By the second quarter of 2016, its share had jumped to 17.5%. Over the same period, the VA's share soared from 0.7% to 8.7%. Of the mortgages Wells Fargo originated in the second quarter, 12% were FHA and VA loans compared to about 42% for Quicken loans. It's largely via this conduit of the shadow banks that the nationalization of the riskiest end of the mortgage industry is proceeding. It has now become completely dependent on government guarantees. According to Richard Bove, Vice President of Equity Research at Rafferty Capital Markets, and I quote, "The government is buying and insuring 60 to 70% of all mortgages. The government owns the mortgage market. It's a nationalized market." End of quote. This artificially pushes down mortgage rates as the risk is borne by taxpayers. Low mortgage rates and no down payment and low down payment subprime mortgages are precisely what's required to inflate already inflated home prices further and drive housing bubble 2 to its peak. It creates the foundation for the next housing bust, where taxpayers and/or the Fed will once again bail out investors in mortgage-backed securities. The reason for this is very simple. Politicians, always eager to buy votes, refuse to get the government out of the mortgage industry. But there is no risk, we hear constantly. Defaults are at a record low. Same as just before the last housing bust. When home prices soar, no one defaults. You can just sell the home and pay off the mortgage. The problem arises when prices head south. Alas, there's just no let-up in dismal tidbits piling up about the condo markets.